Greeting for the day, respective faculties. Me and my group were going to present presentation on technical analysis. We have divided different topics with our individuals. Now, my topic of presentation is Introduction of Technical Analysis. Now, what is technical analysis? Basically, the technical analysis is a study of past market data. It means to say mainly prices and volumes of the data. Then used to predict future price movement, like prices fluctuating how in a manner. So this kind of things involved in technical analysis. Purpose and importance of technical analysis. There are three various purposes importance of technical analysis. It helps to trends and find entry existing point, and it helps us to make long-term and short-term decisions on the assets or in price models. Reduce emotional decision making. It helps to reduce our emotional decision makings. Now we will see what is the difference between technical analysis and fundamental analysis. Basically, the technical analysis is to follow the charts and patterns, but the fundamental analysis is used to take the data of financial health, earnings, short-term, long-term, and focusing on studies what's happening in the market and the asset pricings. Let me see what we learn from this presentation slide. We learn what is technical analysis, we have different types of technical analysis. It studies most data like volumes and market prices and fluctuation and all. And purpose and importance that we learn is making us aware that how we are planning our investments in the different portfolios. We are making different portfolios, and it helps us to make a good decision. We are going to make a short-term decision, or we are going to make a long-term decision. It can help us. So now, at the last, we will learn what is the difference between technical analysis and what are the difference in fundamentals analysis. Technical analysis is studying the charts pattern as we learn, and the fundamental analysis is looking for overall health of the organization and going into the deep of what the root cause and what are the various things that affects the decision making. So fundamental analysis is going for overall evaluation. So now I'm going to complete this slide, which co-heading is Introduction of Technical Analysis. So thank you.
Good morning everyone. My name is Agrima and I study here at Marwadi University with my major as finance, and we have been given a topic for video assignment, and my topic for the group that I am in with is technical analysis and its assumptions. So previously in the previous video they might have explained you the meaning of technical analysis, and just to give you a recap, technical analysis is a statistical tool, a statistical analysis we use in order to understand participants like commodities, stocks and currencies. And here we speak of the assumption of technical analysis. First of it being market discounts everything, when it means that market is reflecting everything in its price. So I believe the trend, the entire assumptions, the economy will be reflected in the price, and it will impact the product and the commodity. Secondly, price move in trends. So the price that you see, the price that you buy your things for moves in trends. It goes up, it can go down, but it is periodic and it can hardly be irregular. And here there is one more where it is a very definitive, where it means that history tends to repeat itself. Human psychology repeats over time, creating similar chart patterns. That also helps in understanding commodities like stocks and currencies, because it will move in a graphical manner, in an analytical manner, where it will move over time. It can move up or downwards, is based on the economic situation. But these are the three assumptions: market discounting everything, price moving in trend in a periodic manner, and history repeating itself in every commodity that we speak of in this video. Thank you.
My name is Krish Motwani, and my topic is technical analysis, assumption of technical analysis, basics, candlesticks, chart and patterns, different technical indicators. Our group name is Krunal Rajpurine Group. The subject is asset management. I will be presenting on the subtopic basics of technical analysis, and my enrollment number is 92201425259. To begin with, technical analysis or TA is the study of past market data, mainly price and volume, to predict future price movements. It's based on three core principles. Market discounts everything, which means all information, whether public or private, is already reflected in the price. Prices move in trends, and identifying these trends helps in making better decisions. History tends to repeat itself because human psychology and behavior often follow patterns. Now, while asset management traditionally focuses on long term fundamentals like earnings, economic indicators, and company performance, technical analysis adds value as helping optimize timing. It answers the when of investing, when to enter and when to exit, or when to stay put. Let me explain this with some of the basic tools used in technical analysis. Support and resistance. Support is where price level buying is strong enough to prevent the further fall. Resistance is price level where selling is strong enough to prevent further rise. Trends, there are three types of trends: upward trend, downtrend, and sideways. In uptrend, higher highs are present and higher lows are present. In downtrend, the lower highs and lower lows are present. In sideways trends, prices move within a range. The third point is volume and importance, which confirm the strength of a trend. Higher the volume is equal to stronger the movement. In asset management, technical analysis is not used in isolation. It complements fundamental analysis. For example, a manager may believe a company is fundamentally strong but will wait for a positive technical signal before buying. This improves entry points and reduces risks. Finally, technical analysis is especially useful in tactical asset allocation, where managers make short-term shifts between asset classes like equities, bonds, or commodities based on market trends. In conclusion, technical analysis adds a practical, data-driven layer to asset management. While it doesn't replace deep fundamental research, it helps time decisions, manage risks, and enhance overall performance. Thank you.
Good afternoon, sir. My name is Olivia Rajelia. Our group today is Ronald Rajpura. So our topic is technical analysis. So I'm going to take part in the technical analysis. My part is going to be candlesticks. That's what I'm going to present about. So as I'm going to start, at least I'll give some information about technical analysis. Alright, first question goes that what is candlestick? So as written there is a graphical representation of price movement in a given time. I can also give another definition saying candlestick is a pattern that gives insight to, let me say, market activities. So this candlestick, it has a lot of things to explain about, but since it's going to be basic that I'm explaining. Let me just say this candlestick has been used for several years by Japanese traders to track the market activities or the movements, the trends, just as I want to say. So it has been used and that has been showing the market trends of it. Say that. So, okay, the candlestick graph can be created by using things like high, low, close, and open prices. So these things they use it to create the candlestick graph. And besides that, the candlestick has 3 rules. Let me mention them. The first rule is okay. As I said, there are 3 main rules, or 3 main important rules in candlesticks. So we're going to look at them. So from these 3, the first one is buy strength and sell weakness. The second one is be flexible with patterns, which means verify and quantify. Then the third one is look into prior trends. So these are the 3 rules that we're supposed to look at. We're going to go into the next part. We are going to the next part of the complex. The complex comprises of the body, the wick or shadows, open and close prices, and low and high prices, then the color coding. So let me try to explain what the body means. The body is the hollow filled part of a candlestick, which is called the body. Sometimes also can be referred to the real body. And then the wicks or shadows, they are the thin lines that are located they can be at the bottom or at the top of the candlestick, of the body, of the body. And then open and close prices. So open and close prices are indicated, like for the bullish type, which is the bullish type, the open prices are located at the bottom. Then for the bearish, they are located at the top. Then the close prices for the bullish are located at the top. Then for the bearish, they are located at the bottom. Then high and low prices. The high and low prices of the candlestick, or the high and the low prices, they are located. They are at the high at the top. Then the low prices are coded at the bottom. Then the color coding, which is the last one for the complex. The color coding, and they help indicate the markets, movements. Okay. Then about this, there are 2. There is a bullish, the bearish. The bullish indicates the green. Then the bearish indicates the red one. Right. The third part is basic candlestick patterns. We have the doji, open close and decision. The doji, it explains this is the type of pattern used in trading when the open and the close are unidentical. The open and close pattern of the trading are almost similar, not identical. So this same thing is used to identify market sentiment, and also used for price behavior, or understanding price behavior. So it's mostly neutral. It shows the neutral result. And hammer bullish value. This thing is characterized by the small body near the so that it will be the same range. The shooting star is a bearish candlestick that is based on its own. The bullish one is the one that's also known as a inverted hammer. This is formed when currency pairs prices stop falling in reverse and rise again. So this is going to be the end of the candlestick basics that I have to explain for the day. Thank you.
Good morning everyone. Today our topic is technical analysis, assumptions of technical analysis, basic candlesticks, chart patterns and different technical indicators. Our group name is Kunal, Rajpura and group. Myself Kushal Vaidya from BBA Honors A Division. Today my topic is chart pattern. Basically chart pattern is what we understand is that understanding technical analysis of a company, that knowing that whether company is being profit or being in a loss. We, by understanding the technical analysis, we used to know whether this share of a particular company should be bought or not bought. Chart patterns have three types. One is the reversal pattern, continuation pattern and spotting and using pattern. First is a reversal pattern. Under reversal pattern, there is head and shoulder and single trend reversal, top, double top or bottom, trend reversal confirmation. Head and shoulder are basically comes under a candlestick of a particular graph. What we see is trend reversal is basically for if a particular share is going in uptrend, then sudden of a correction in the market and it goes down. It's known as trend reversal. Second is a continuation pattern. Under continuation pattern there is flags and patterns, brief pause and then continuation, and under that there is a triangle breakout after consolidation. Basically triangle breakout and consolidation means that there are three types of triangles. First is ascending triangle, descending triangle and symmetrical triangle. Ascending triangle is a triangle where the market goes in uptrend total, whereas the symmetrical triangle is market goes in a downtrend, and a symmetrical triangle is the market remains in a cost, there is no profit or no loss in the market. Then is spotting and using patterns. Under that there is identifying shape and value and confirm breakout or reversal. Identifying shape and value. The shape basically tells about graph of a particular company, that graph is going in uptrend or downtrend, having a cup and handle graph, having a symmetrical triangle, having a ascending triangle, what type of gap is having, what lower the market is facing is known as shape. Shape is basically it depends on the totally market fluctuation. Volume tells about how many time a particular share of a company is being exchanged or traded in the market. It tells by having a volume, it tells a company's valuation, how the company good or bad is about. Confirm breakout or reversal. Breakout is basically if, for example, a company's graph is going in a uptrend or a downtrend, it suddenly comes a breakout, and after breakout it gives a small amount of correction in the market. There are various type of chart also provided by NRPPT also. Reversal is basically when a graph goes on a uptrend and suddenly it comes to the in a downtrend because of the market fluctuation. Thank you.
Good morning friends. Good morning sir. Myself Sujal Lotari. I am from BBA Honors, same 6 Division A. So today my presentation topic is technical analysis. Assumption of technical analysis, basics, candlestick, chart pattern and different technical indicators. So my group name is Kunal, Rajpura and group, and sub topic is key technical indicator. Key technical indicator. The first, moving average. In moving average there is two type of average. First SMA and EMA. In SMA, simple moving average is a simple moving average of the post price, and second is EMA, expenditure moving average. It gives more weight to the recent price, so it is react fastly. So basically it have to identify the direction of the trend, it's going up or down. So second one is RSI, relative strength index. RSI shows the market strength and weakness. So So in this one, above between the 0 to 10, the above 17, the market may be over budget. It possibility the price will drop. And if the below 13, the market means market be oversold and the possible price will. So basically in RSI, it is useful for identify the exit point, entry and exit point. So third one is MACD, moving average conversion and diversion. So track movement and trend change. There is three line: MACD line, signal line, and histogram. So when MACD line cross the above signal line, it indicates the signal of buy. If MACD cross the below, it means the sell signal it will give. And histogram shows the strength of the signal. So fourth one is Bollinger Band. It shows volatility of price movement range mode of three lines: middle line, upper line, and lower line. So middle, it's moving average, and upper and below bone, it shows high and low range. When the bone are narrow, the market is stable. So usually price is written in the middle line. So done. Thank you.